Test. 1, 2, 3. Okay, good. All right, so I hope I'm in the right class. This is Masters in Finance students mostly. Yes. Okay, good. Yes, so welcome to a new semester. This is International Financial Management, EF 5143. This is the first class of the week. There are 3 sections. So my understanding is that you guys are all fairly busy with potentially interviewing with future employers. And so if you decide to attend any other class listed here. So this is section S61. If you decide to take, for example, Wednesday 12 or Thursday 9 a.m., I'm perfectly fine with that. Just make sure if you plan on taking, for example, a midterm or final exam, or probably not final exam, but midterm, for example, at a different section than the one you're assigned, you have to let me know ahead of time. So I'm giving you this flexibility to attend whichever section you want. Just let me know ahead of time if you are, going to change sections for a test. All right, so I gave you the class time here in the classroom, etc. All information for this class will be disseminated through Canvas. So hopefully you saw this Canvas. So you guys used this last semester, right? So same thing, I'm just gonna post every week the slides ahead of time, summary slide, which basically gives you the key points of my lectures, and as well as case studies that I'll talk about and potentially other interesting articles that may help you understand the subject better. Okay. So let me first go over the syllabus so that you guys know what you're getting yourselves into before we start the topics of today. So our objective in this class is basically twofold. So Masters of Finance students, I presume that you guys have taken corporate finance and maybe some derivatives course. This is a very applied course, meaning that we're just borrowing concepts from other courses and applying it to a different asset class. So in this class, we're primarily concerned with returns on holding foreign currencies. All right, that's the meat of the subject today. So, or in this course. So we're going to borrow stuff from derivatives pricing, forward contracts, futures contracts, and then we're going to borrow stuff from macro. If you have any background on that, that's great. Otherwise, it's okay. We're going to start from scratch, and you should basically get a very good introduction of what macro modeling is like and how that's going to help us link the financial markets with the macroeconomy. The reason why that's important to us is because, as you can imagine, foreign currencies is linked to not only just financial markets, but also real goods and services that's produced from a country. Why do we care at the country level? Because currency is primarily issued at the country level. So that's our objective, trying to take asset pricing models you learned from the previous semester and try to fit it to price foreign currency returns, and then try to link foreign currency returns to the macroeconomy. And if I accomplish that, then great, right? That's my objective here. So in that case, then I take most of my material from these 2 textbooks. You don't have to get these textbooks. If you want additional practice problems, for example, you can reach for these textbooks, look at the problem that's being offered in the textbook. But all you need to do is study the slides in this class, and that should be enough to do well for this course. All right. So again, the textbooks are optional. I don't expect you to know every nitty-gritty detail of the textbook. As long as you master the information in the slides, you'll be fine in this course. For grades, it's basically 50-50 final exam and everything else. Everything else is just 2 case studies and a midterm. So I call this midterm an in-class assignment, basically, because I don't want you guys to study for it. It's open book. And so I think of it as just an in-class assignment that you have to do by yourself and submit it within, 2 to 3 hours. Okay. Once you have those 2 components of the assignment, right, then the other half is your final exam. And you should expect the final exam to be very similar to the homework assignments or the practice homework assignments I give you in the midterm. All right, so I'll talk more about that, of course, later on. But anyways, that's the breakdown of the class and what you should expect to do for this course to get the grade you want. All right, so 2 case studies. I will give you the case studies way ahead of time, so you will have plenty of time to think about it and work on it in your groups. So I'm going to let you work either alone or within your groups. You don't have to stay within the same group for the second case assignment, so you can do whatever you want. As long as you submit one version of your case study on Canvas, and that's fine. So I don't want to see duplicate names or whatever, that's fine. Just one version of the case study with your name on it. And that's good enough. So if you want to, share the work, one person does one case study, the other person does the other case study, I don't care, that's fine. If you're okay with other people free writing off of you, that's also fine. It's completely up to you. I leave it to you to decide what your groups are going to be. Okay. Throughout these 13 weeks, I will give you ungraded problem sets to work on. And this should give you an idea what you should expect to be on the midterm and final exam. So they should be very similar in the design of the questions. Of course, I will give you perhaps more context and more perhaps related to recent news and events that has occurred to make you think a little bit harder how to fit current events within the framework that's going to present to you in terms of economic modeling and so forth. Okay. All right, so that's basically the logistics of this course. So if you have any questions, you can ask me now. So I think it's there's no really real deliverables until I give you the case studies, right? So other than the midterm, it's basically up to you to how hard you want to work, how frequent you want to come to class. I'm not going to take attendance. I have an attendance sheet here. So this is required by my department. If you have friends, fill it out for I don't care. Yeah, so I will circulate this during the break. So while we have around 3 hours together, we will take a 10-minute break, an hour and a half in, and then I'll just circulate this, and then you just write your name, and that's it. Okay, I'm not going to use this to assign grades at all. So it's completely up to you, how frequent you want to come to class. So as you can see from these monitors here, I will record the lectures. All right. So if you decide not to come, that's fine. I will make them available to you to watch after class, or if you decide you're sick for the day, it's online for you to look. Okay. All right, so let me give you a brief overview of what to expect for this course. Week 1 and 2, we're going to talk about just institutional details of the FX markets, which currencies are the most traded, how do you convert from one currency to the other, what's the disciplining force to price currencies, for example, no arbitrage, where does that come in for pricing currencies? That's what we're going to do in the first 2 weeks. Week 3 and 4, I'm going to give you an asset pricing model on returns on holding onto foreign currencies, and then try to slowly link it to the macroeconomy as we approach week 6, okay? And then you'll have the midterm. After the midterm, we'll talk more about policy. So why do you care? Well, some governments, for example, like the US, who have new presidents, like to implement tariffs. And you would, from a investor perspective, you kind of want to know what the implications of tariffs on prices and how prices translates to holding onto foreign currency returns, et cetera. So this is all very important and relevant, I think. So we're going to shift gears in week 7 to talk about more macro stuff and less asset pricing stuff. Okay, so we're going to talk about fiscal policy. So that's government spending. We're going to talk about monetary policy. That's controlling the money supply and interest rates, and try to show you the mechanism of how changing these variables can ultimately impact FX returns. And then week 8 and 9, building on top of the policy perspective, we're going to think about other types of currency regimes that may exist, such as pegging. So Hong Kong is a special case because the Hong Kong dollar is essentially pegged to the US dollar. And we want to know the implications of that, right? And we'll compare and contrast the flexible exchange rate regime versus this pegged regime that Hong Kong has and the implications on policy and so forth. All right, and the last third of this course is going to be on financial derivatives. So this is mostly review. So my understanding is that this class is open not only to you guys, but also to accounts. So I have to make the class a bit digestible and also not too difficult. All right, so accountants, I'm teaching accounts tomorrow. So I suspect most of the discussion on swaps, futures, and options will be reviewed. So that's unfortunate, but that's how the course is designed because it's open to these kind of people. But in any case, I will review these derivatives and contracts that you should all be familiar with, but within the context of foreign currencies. Okay, that's it. So it should be mostly a review, but just things to think about when you have to consider foreign currencies as opposed to bonds and stocks and so forth. Okay? And lastly, if given time, I will talk about cryptocurrencies, but just from the economics perspective, not too much of the technical computer science perspective. Okay. All right. So that's the whole course. All right. So 13 weeks, basically split into thirds: FX markets, macroeconomy, and then financial derivatives and cryptocurrencies. Right. Any questions on the overview and logistics, expectations? Okay. All right. So let me get to today's lecture then. All right, so all right, so I forgot to mention, I have 4 TAs this semester. The reason is because there's 300 of you guys across 3 sections. Okay, so I don't have any particular assignment of which TA is for any section. So if you do have questions about the homework or the midterm grading, these are the people to talk to. Otherwise, you can send me the direct message on Canvas, and I reply fairly quickly. So don't be afraid to just say anything on Canvas. And if I think your question is important, I will share your question with the rest of the students in EF 5143. All right. Yeah. Main objective: how to price foreign currencies. Secondary objectives: linking to the macroeconomy. And the third objective is how to hedge, right? Financial derivatives and so forth. And for those of you who are thinking about the CFA exam, if you haven't taken it already, most of my style of exposition of this course is related to the CFA exam. So when I write questions on exams, it's going to be quite similar to the exam questions that you see on a CFA exam. So hopefully it's going to help you at least practice. All right, I think I talked about this. And all right. So pre-knowledge, okay? So what kind of knowledge should you have coming into this class? So this is why I gave you the survey ahead of time, because I kind of want to know what your backgrounds were before taking this class. So let me explain to me why those 3 topics are important. So corporate finance. Why is corporate finance important? It's because you have to understand the disciplining force that allows you to price securities and assets in the world, right? And if you understand that, then you basically know how to price basically any sort of asset with cash flows. And foreign currencies is really no different than pricing, as you will see, okay, as you will see through the slides. Pricing foreign currencies is really no different than pricing a bond. Okay, bank deposits pay an interest, and with interest payments, you can do DCF analysis, etc., and you can price, foreign currency derivatives quite easily. And so, if you understand why we do DCF and corporate finance, then it should be no problem understanding the models that's going to be presented to you in this class. Macroeconomics is usually quite abstract, and students tend to struggle with macroeconomics unless they were exposed to it, for example, in undergraduate courses. So I'm going to present macroeconomics from a MBA level of of topics. Okay, so how do you model aggregate demand? Where does aggregate supply come from? What is changing the output? What sort of effects does changing output have on interest rates and so forth? All right. So these are very simple static models that's taught to undergrads, but it's fairly palatable to MBA students. And so I'm just going to present this kind of MBA stuff. Of course, it can be fairly complicated if you want it to be, but I think that's a bit too much for the accountants. All right, and lastly, I asked about if you knew anything about risk management. The reason is because if you don't have any background on futures, forward contracts, options, then I have to spend a lot of time explaining to you how to price these contracts to begin with, right? And that's basically a whole semester of work. So I'm going to skip all that. I'm going to skip the pricing of all that, and I'm just going to tell you what changes in the model, in the pricing model, to fit pricing FX returns. Okay. All right. A reminder that I will use some calculus in this class. If you're not familiar with calculus, don't worry. I will derive everything step by step, even without the calculus. You can just get away with it, just memorizing the mathematical formulas, and that's good enough. Okay. Calculus is important because we want to know how changing one variable changes another, right? That's the only way to, that's the only way to do it in math, right? You need to be able to calculate the derivative to understand relationships between two variables, and you need calculus to do that. So it is unfortunate that I have to do this, but I think this is good for you, okay? All right, so before I begin, let me tell you about myself. My name is Shenjie Xie. I was born in the US, and I grew up in California, but I got my PhD in UCLA in Southern California. Before that, going to UCLA, I worked at the Federal Reserve Board, so I have some experience with fixed income and the Treasury market. All right, but my research is totally different now. Okay. Any case, I live in Hong Kong since 2017, and this is my third time teaching this course. So I'm fairly fresh. So I don't know what you guys, what's interesting to you guys. So if you read something in the news and you think it's interesting, you want me to talk about it, I can. All right, you just have to let me know, and I can spend some time to make some slides, and we can all talk about it together and learn something. All right, but I will do my best to kind of look at the news every day, and if I see something that's relevant, I'll share it with you and spend some time to talk about it so that you know what's going on. All right. So let's start today by just asking the most fundamental question you can think of, right? So the course is called International Financial Management. But it has several other names. Sometimes it's called International Finance and Banking. Sometimes it's called International Trade. Sometimes it's called International Economics. They're all the same thing, okay? And if you want to just give you the plain simple definition, it's probably not very interesting. I wrote it down here. International finance is defined as monetary relations between two or more countries. So what are monetary relations? The boring answer is we're talking about the relationships between central banks. Okay, central banks control one key macro variable that you should all think about: the money supply. Changing the money supply changes interest rates, and changing interest rates changes everything, right? The discount rate to price bonds, the discount rate to price mortgages, the discount rate to price equities, and our objective here is to understand, all right, how does changing one set of interest rates / money supply permeate through the rest of the global economy, right? And it all depends on the institutional structures and so forth. For Hong Kong, because we're pegged to the dollar, we have a mechanical relationship with US interest rates, right? But for some other country that has flexible exchange rates, what are the implications for that? And so that's what we want to try to do. We need a framework to think about relationships between different interest rates and therefore between different central banks and therefore different money supply. All right, so interest rates is one thing. Inflation rates, so why is inflation rate important for us? Well, if I change the money supply, that means that all else equal, there's more money chasing the same amount of good. So we should expect prices to rise perhaps over time. And so inflation rate is also something you must consider when thinking about changing money supply. And if one set of prices change in one country, what sort of implications do they have for another country? And so this is kind of important, as I mentioned earlier, when you think about tariffs, right? Tariffs is like imposing a tax on a certain good, elevates its price. What are its implications for the macroeconomy elsewhere, right? So that's what we're going to investigate later on as well. And lastly, the intermediating channel, of course, this is all done through exchange rates, right? This is the conversion rate from one set of currency to another, and allows us to explain why prices are different between countries or why interest rates are different between countries, et cetera. All right, so we want to know what determines this and how determining this has implications on inflation and therefore on interest rates. So we will build a model eventually that combines asset pricing theory referring to the disciplining force of the law of one price, no arbitrage, with macroeconomic theory, linking it to aggregate demand, aggregate supply, total output of an economy. That's the objective. All right, so summarize. What is international finance? It's just monetary relations between countries. All right, and that entails many, many things, but two main things, right? Interest rates and inflation, and that's done through exchange rates. All right. So with that in mind, it's clear to us now that our focus should be at the country level, right? Countries define the central banks. The central banks builds relationships, and the central banks are, for the most countries, are the sole issuers of currency. So the big question after defining what international finance is what exactly is money, right? So if you've been, I don't know, following Bitcoin and cryptocurrency news, they all have various definitions of what money is. But if you spend money on a day-to-day basis, you should just look at your currency outright. That's the first thing you should do. Look at the money in your wallet. I know in China, you guys don't carry cash anymore, but since you're living in Hong Kong now, at least pull it out and take a look at what it says, okay? So I have this Hong Kong dollar here, so let me zoom in to emphasize what I want you to pay attention. So the first question I have for you is, other than how much money this is 100 Hong Kong dollars, who is the issuer, or what institution is the issuer of this currency? So in English, it's the Hong Kong and Shanghai Banking Corporation Limited, Shanghai, Huifeng Yinghang, right? So that's your issuer. So you have a bank, right? You have a bank that's issuing a certificate, right? It's a certificate that says that you are entitled to something. So what are you entitled to? Let's take a look. Promises to pay the bearer on demand at its office 100 Hong Kong dollars. So my question is, all right, if I hold on to this, do I actually have Hong Kong dollars, or is it a promise to get the so-called Hong Kong dollars once I present it to the bank? So the obvious answer is, the answer is that I don't actually have the Hong Kong dollars. I have a promise that I get it if I present it to the offices of HSBC, right? And so based on this characterization, it looks like, what kind of contract does this look like that you've seen before in your corporate finance class? So it's a promise to give you something, and you're holding on to that promise. So what is it? It's something you've seen before. It's a debt contract, right? They owe you something. They promise to give something to you, and you're holding on to that certificate that says, if you give it to me back, I will give you 100 Hong Kong dollars, whatever that is. All right, so that might be confusing to you right now, right? Like, what does that mean? All right, so maybe I give you something that's a little bit more straightforward. So instead of something as abstract as dollars, why don't we just look at a money that does exactly what, gives you something in return for holding onto this certificate. So in the past, the US and several other countries like the UK and some African countries, the money is backed or was backed by gold, right? There was a conversion rate between dollars or pound sterling, for some quantity of gold. So if you look at old money, so this is an old $100 bill that was issued, I think it's hard to read. I think this is 1928, so a long time ago. But in the text, you can see that it's redeemable in gold on demand, right? You can't see, maybe I'll try to zoom in a little more, okay? So I know it's a little pixelated, but this word says gold, all right? All right, so holding on to this certificate, what have you effectively done with the government? So holding on to the certificate. Are you a lender or are you a borrower? You hold on to this currency. You basically, so let me answer the question. You are basically lending the government gold, right? They can do whatever they want with the gold, and you hold on to that certificate. So you are actually a lender in this scenario by holding on to money, okay? So the punchline here is that currency and debt is basically the same. And you should start thinking of it that way in this class. Currency, debt, basically the same thing. The only difference, right, is really just maturity, right? So imagine you have a debt contract that expires 1 year, right? All right, very short tenure. Okay, I hold on to this certificate and I get the principal back plus interest after a year. All right, let's change the tenure from 1 year to half a year, and then maybe move it even closer. Change the tenure all the way back to just 1 day. So what's the real difference between a debt contract that expires in 1 day versus the principal? Not much, right? So money and debt, you should just really be thinking that it's almost the same. So if you are holding on to cash, if you're holding on to debt, then you are essentially lending to somebody. All right. So what this means is that you are basically giving the government credit, right? You're giving them credit by holding on to cash. Okay. All right. So that was back then. Back then, a lot of currencies was backed by gold. In fact, during the 1800s, maybe even earlier, under the gold standard, all major currencies were backed by gold, which means that you can take that certificate and go to the central bank and convert it for some quantity of money. But nowadays, I think there's only one country that has currency that's backed by gold, and that was issued just this year. So I'm assuming everybody knows Zimbabwe, right? Zimbabwe, hyperinflation, currency totally worthless. You go on the streets, you have money littered everywhere. And so in order to address that, they decided to peg their currency, now called the ZiG, to gold. And you can even see that in the back of the currency where they're melting gold into gold bars. Okay, so this is clearly, yeah, it's currency backed by gold. All right. But everywhere else in the modern day, doesn't matter which currency you look at, they will either say nothing, backed by no description about what you're entitled to. But if they did, all they will say is that promise to bearer to pay on demand, right? Pay on demand of X amount of dollars. Okay. For US dollars, same thing. This note is legal tender. Legal tender means that you can use this money to service any sort of liability or debt. So if I owe money for buying something, I can just pay for it itself. I can just use this money to pay for it. So it's not backed by anything. Money is no longer backed by anything. Even if you look at the pound sterling, promises to pay the bearer on demand the sum of 50 pounds. So yeah, nothing to do with gold, no backing whatsoever. It just means that the currency is fiat, right? It's just backed by the faith in your government and also by the strength of your import, exports, etc., your macroeconomy, the credit worthiness of your country. All right. Questions, comments? So punchline again. Money should be thought of no different as debt, right? Thought experiment is if you take a debt contract and you reduce the maturity all the way from, X amount of years to close to zero, money and debt, basically the same thing. If you hold on to money, you are extending credit to somebody. So if a country, for example, exports something and you take their currency, that means you're extending credit to your counterpart, the other country. So we'll talk about this later, right? As long as you take cash, you are extending credit to somebody. Okay. All right. So that's the intuition, and this will come back, okay, very soon. So I will talk about pricing currencies essentially in two ways. The first way, which is probably most obvious to you, is to think about pricing foreign currency using financial assets, which we will do next week, okay? Today, I want to just give you the intuition of why there should only be one exchange rates, or what that one single exchange rate should be and what it represents, okay? So I think the best way to show this is just to try to derive the exchange rate by comparing homogeneous goods between countries that's being sold in two different countries. Okay, so let's just walk it through, right? What does the exchange rate really represent? So we can do that by looking at trying to derive the exchange rate based on goods that are identical across countries, and assuming there's no tariffs, etc. No arbitrage says that I can't buy at low and sell high given this exchange rate, right? That's the idea here. All right, so here I have a very, very common consumption good, a bottle of Coke. And let me demonstrate to you that this is a homogeneous good. So Coke Zero, right? This is both Coke Zero in both countries. So here we have Tesco, which is a supermarket in the United Kingdom. I don't know if it's in mainland China, but they have supermarkets in Hong Kong. But anyways, I'm looking at the price in the UK. It's 1.25 liters, 1.25 liters. As far as I can tell, there's no difference in formula or taste, okay? And we have a price. So for a bottle of Coke Zero in the United Kingdom, it's priced at 1.45 pounds. In Hong Kong, it's 11.50 Hong Kong dollars, right? So just based on the fact that we have identical goods with two different types of currency prices, that means that in order for no free lunch on the table, no arbitrage, there must be a conversion rate that, sets the value the same, right, across these two countries. Otherwise, somebody can just buy, just carry lots of Coke and bring it to Hong Kong and sell it, for a premium, right, for on a markup. All right, so how do we do this? How do we identify the conversion rate? Well, it's quite simple, right? We just say there must be some exchange rate that once I use it to convert the price of the good in one country, I should get the same price in the other country. So here I have the price of Coke in pound sterling. So GBP, I believe the GBP stands for Great Britain, but they call it pound sterling. It's the currency of the United Kingdom. That's the price of one Coke, right, 1.45. Once I convert that to Hong Kong dollars, there must exist a conversion rate. So I'm going to use the letter E to designate the nominal exchange rate. So that's just the price of British pounds here, or pound sterling, in terms of Hong Kong dollars. So in this class, I'm going to assume that we are in Hong Kong, okay? And which means that prices, and therefore the price of not only commodities, but also financial assets, are going to be denominated in local currency. So if the local currency is Hong Kong dollars, it's going to be in the numerator. Okay? So the price of £1 is going to be E Hong Kong dollars. So that's how you should read it. So let me re-emphasize that again. I think a lot of students come into this class thinking that, oh, exchange rates are just ratios. Yes, you can think of it as a ratio, but I think it's easier to understand everything in this class if you just think of foreign currencies as simply as being priced in a different currency. So if pound sterling is the object of to be priced, then E is therefore the price of the pound sterling. So it's more than just the ratio, right? It's the price of something. Okay, so multiplying 1.45 by E should give me Hong Kong dollars, right? The price of a Coke in terms of Hong Kong dollars, which must be 11.5 per Coke. Solve for E, we have a exchange rate of 7.93. Okay, so easy peasy, right? That's super easy to price things when you have a single good to represent an entire economy, right? But of course, that's not reality. So as I wrote here, this is only for one good, right? The macroeconomy is massive. People's consumption baskets vary from country to country. People like to consume a lot of something here. I think Japanese food is really big here, but not so big in other countries. And so the price, you should see, obvious price differences between these preferences. So let me give you an example. Cars, right? Real estate and roads are quite limited in Hong Kong, so owning a car should be a luxury, and therefore that should be reflected in the price. Whereas some cars are manufactured in the United Kingdom or manufactured in the Eurozone, and therefore import exports is probably cheaper, and therefore you might see cheaper prices for cars. And so here I'm going to show you the same good, but being priced in two different countries with different prices will imply a different exchange rate that we saw before, right? So here, let's do the same exercise. We have this car, the new Jaguar F-Pace. It has two prices, one priced in pound sterling, the other priced in Hong Kong dollars. Law of one price tells us converting pounds to Hong Kong dollars using the conversion rate must be equal in value to the Hong Kong dollar value, right? So solving for E gives us something that's totally different, right? There's many reasons why this is the case. So I gave you several reasons already. Import, export taxes, right? There could be material costs that's not being factored in. That's there may be labor unions, right? There could be, as I said, tariffs too. Many things, right? There's many reasons why the prices could be so vastly different between these two countries. And so deriving E from a single commodity or consumption good is not a good idea. And the question I pose to you here for now, which we'll get to later, is how do we reconcile that E must be able to service basically all goods and services within an economy? How do we reconcile that? The way we reconcile this is to think of E as an average price. And so we're thinking about an average price of what, right? Average price of a consumption basket. So if you think about E that represent average prices, then we're thinking about average consumption basket of an economy. And so with that in mind, that allows us to kind of reconcile what E should be and what it represents, okay? So if you have Hong Kong dollar, that means that you have, so if I accept Hong Kong dollars, that means that I have purchasing power for an average basket of goods produced within Hong Kong, right? If I own US dollars, I have access to goods and services being produced in the United States. So having currency, therefore, doesn't mean that, it's based on some specific commodity or good, consumption good. It means that I have access to the entire economy, whether I buy cars, clothing, software, whatever. It's a representation of consumption or things that's being produced within the economy, within a country. All right. So that's the that's the intuition for the real side, which we'll get to by the end of week 6. But hopefully that gives you an idea of what E should represent, okay? The exchange rate. Comments, questions? Okay. All right, the other side. The other side of exchange rate, pricing exchange rates. So this is the perspective that I'm going to focus on for the next few weeks. If we don't think about specific commodities and consumption goods, the other type of thing you should think about is financial assets, right? So the law of one price also has to apply to more or less homogeneous financial assets between countries. And the most fundamental asset that's created within a country is their debt, right? So US issues US treasuries, Switzerland makes, they issue their bonds, the United Kingdom issues gilts, they all have different names, okay? But my point is that these bonds, if the country is more or less creditworthy, the returns on holding these financial assets should be, after controlling for risk, should be comparable, right? Holding on to gilts is the bonds issued by UK. Holding on to gilts, you're exposed to some sort of risk, but that risk should be comparable to the risk of holding on to US treasuries. If that's the case, then the law of one price tells us that these returns on holding either UK gilts or US treasuries should be priced the same way after currency conversion. Do you agree? All right, so let's maybe not think about debt. Let's just think about bank deposits. Swiss banks, quite safe, right? They're very, very liquid. I mean, they are not limited by they have no liquidity constraints. If you stress test these banks, they won't collapse overnight, right? So Swiss banks, very safe. US banks, I think they're still quite safe, okay? If I put money in a bank in the US, I could earn some sort of interest rate for basically risk-free, right? Same thing for Swiss banks, but they may have different interest payments, right? If that's true, then it's possible to kind of take advantage of these interest rate differentials between banks, right? We already know that these banks are quite safe, right? Let's just say their credit worthiness or the risk of these bank deposits are 0, okay? No risk. If that's true, and they have different interest rates, then the law of one price tells us that after currency conversion, these two bank deposit returns should give me the same return, right? The argument is identical to the argument I made about Coke and cars. If these two assets give me the same cash flows or returns for the same risk, then I should not be able to make free money. So let me give you a concrete example. Suppose the US pays 0% on their interest, but Swiss banks, for some odd reason, pays 10%. How do I make money from this, all else equal? Well, what I could do is borrow at 0% and then lend to the Swiss banks at 10%. If nothing changes, I make the spread, right? 10% minus 0%, risk-free, right? Because I just borrowed, it's not my money. I borrowed money, and then I invested in Swiss banks, earned 10% interest, and then I pay back my loan. So I just made 10% without using my own money. Of course, that shouldn't be possible, right? That's free money. And if you think about it, the mechanism to eliminate this risk-free profit is due to the fact that I have to do some sort of currency conversion, right? So let me walk you through the steps in order to take advantage of this interest rate difference. So if I borrowed in US dollars at 0%, in order to deposit my money in the Swiss banks, I have to sell my dollars for Swiss francs. Do you agree? In order to deposit money in a different bank that pays interest rate on only their domestic currency, I have to sell the currency I borrowed for the foreign currency. And then I can deposit the money in the Swiss bank, right? That's how I make this, that's how I make the difference, right? After a certain amount of time where I get that 10%, let's say 1 year, I have to convert my currency back, right? I have to sell my Swiss francs back to dollars to service my loan, correct? But the fact that I'm doing all this currency conversion is going to eliminate any sort of arbitrage that I'm trying to take advantage of, right? Because once I borrow the currency and sell it, I'm going to raise the price of the purchased currency, right? If I'm going to buy Swiss francs is going to get more expensive over time. And so the ability to take advantage of this is going to disappear almost instantaneously if it does exist to begin with. Make sense? So let me walk you through the steps again. Again, we're just applying the law of one price for a bank deposit, right? We're just doing bank deposits, law of one price. Just like commodities and goods and services, we are just saying that for identical assets that pay the same return for given risk, those assets should be priced the same after currency conversion, right? Otherwise, there's free money. So the example I give you is, let's borrow low 6%, 0%, and then lend out, deposit the money 10% somewhere else, and wait for a year to get my money back, my interest, and then I pay back my 0% loan, right? If nothing happens, yes, you do make 10%, but that's most likely not going to happen because once you try to do this, the opportunity window will close. The reason is because once you start converting your currencies, right? Once you start, for example, converting your dollars to Swiss francs, the price of Swiss francs is going to increase. And that's going to make the US dollar weaker, right? So that's another key thing to remember in this class. Something comes up, any value goes up, the other currency is going to go down, right? So if Swiss francs become more expensive, that also means that US dollars is becoming cheaper, right? So you have a weaker US dollar now. All right, so with that in mind, the depreciation, the weakness of the US dollar is going to cut into your profits too, right? All right, so with that, hopefully you now have an idea of why foreign currencies, when priced either using commodities or goods and services versus financial assets, leads to the same conclusion. We're just applying the law of one price and realizing that in order for the law of one price to be true, exchange rates must be able to eliminate arbitrage, right? The opportunity to make something from nothing. So from the carry trade, okay, so I forgot to mention the name. The strategy that I outlined here, where you borrow low interest rates and you borrow high interest rates, there's a name for it. It's called carry trade. If you implement a carry trade, that opportunity window will close very quickly because once you decide to take advantage of it, exchange rates will change to close the window, right? Just as if you see the exchange rate not being identical to 15.84, right? If it's not 15.84, you can arbitrage. You can buy low, sell high cars in this case, or buy low, sell high Coke Zero. In this case, you're doing the same thing. You're just buy low, sell high in terms of bank deposits. We're doing the same thing. So bank deposit returns should be priced in the same way such that there's no arbitrage, right? And so the E, therefore, must not only be able to convert commodities, goods, and services, but also convert prices between identical assets between countries too, right? Namely, bank deposits / government debt, so forth. All right, so hopefully I didn't lose anyone. If I did, just let me know. I can happy to repeat it again. But But the general idea here is we're just using the disciplining force of the law of one price to derive E in two different ways. One from the overall economy price level, which we'll talk about later, and also from borrowing and lending bank deposits rates between countries with similar risk profiles, right? So that's a very important condition. Assuming that the two countries have similar credit worthiness, then this must be true. Okay. All right, so let me give you some terminologies here. Unlike your stock class, we say different things for returns for foreign currencies. When we say positive returns, what we're saying is actually appreciation in this class. So appreciation is typically referring to the foreign currency. For the foreign currency. So these terms referring to the foreign currency. So positive returns, appreciation, that means that the local price level for the foreign currency is increasing over time. So if I don't know, a bottle of Coke is $20 and it increases to $40, right? And it's 40 minus 20 over 20, right? So same thing for foreign currency, it's 40 Hong Kong dollars. In the previous period, it was $20, and it's 40 minus 20 divided by 20. And depreciation is when prices go negative returns, go down, right? Okay, so what I'm going to talk about over the next hour is going to be somewhat dry, okay? The reason we need to talk about this is because we want to understand how changes in foreign currency will permeate through the macroeconomy through price levels. So we need to kind of understand where that's going to take place. It's going to take place namely through import exports, right? Changing the FX rates changes price levels. Changes in price levels will change import exports. That's kind of the channel, the linkages we want to build. And in order to understand import export documentation at the country level, we need to talk about macroeconomic accounting. This has nothing to do with real accounting, okay? So do not confuse with, balance sheets and assets, liabilities, whatever. This has nothing to do with that stuff in your accounting class. This is just a way to document trade flows between countries and understand what's called the current account is actually measuring when it increases and decreases and so forth. Okay, so that's what I wrote here. So for now, just think about, when I say current account, I'm referring to commodity flows between countries. So if I sell computers to China, that's an export, right? That increases my current account. So EX minus IM, okay? So for now, just think of it as that. I think that's the most simplest explanation you should think about now, okay? All right, so let's go ahead and try to understand what the current account is by talking about some macroeconomic variables. Okay. So maybe I'll give you the formula first, and then we'll talk about why these variables matter. So macroeconomic accounting comes from this equation here. This looks like GDP, right? So for those of you who have macroeconomic background, this looks like GDP, but in this class, they are not the same. The reason is because we are not focused on output produced within the boundaries of the country. So if you think about GDP, the way the GDP is defined within anything that's produced within the physical boundaries of a country. So foreign companies operating in Alaska, that's also counted in GDP. So if you have WeChat employing people, paying wages, that's added to the US GDP. What we want to focus, however, on is we're going to try to exclude income coming from foreign institutions and individuals. The reason is we want to focus on the true creditworthiness of a country, which should not depend on the creditworthiness of foreign institutions and companies, right? Because they're sending money out of the country, right? They're sending money out of the country. We want to know the people who are making money and living in the US, borrowing, lending, and so forth, right? And so that's why we kind of want to refine the definition here for this class. All right, so why are we doing this? The reason is because we want to focus on national income. All right, so the way to motivate this, is to think about how creditworthy an individual is based on, all sorts of variables that you can think of. So if you want to take out a loan to buy a house, what's the first thing the bank looks at before they decide in order to decide how much they give you money? Your income, right? How much money you make. And so what we want to do is try to focus on a country's income that's kept within the country. So any money that's going to leave the country should not add value or help with the creditworthiness of your ability to borrow, right? Because they're not keeping the money in the country. People aren't spending the money that's made by WeChat in the country. They're moving back to China. And so we're going to try to refine GDP so that it's only keeping income that's produced domestically. And we focus on income because we care about how to measure creditworthiness, the ability to borrow. Okay? So this is important, right? We care about ability to borrow because that's really what having money means. If I'm holding onto cash, I'm extending credit to somebody. If the US government's printing money and all the citizens holding onto cash, you're lending credit to the government. But what's more important is if US government is exporting dollars outside of his country to other countries, people are giving credit to the US government, right? So we care about creditworthiness, or in other words, income here. All right, so what sorts of variables may income your creditworthiness, or how much income you make? So I'll give you some variables to think about when you leave today out of this class and open up a newspaper. These are things you should think about when reading the news, okay? Unemployment. Why is unemployment important for income? Because more people are employed means more income generated, more spending power, more consumption, etc. Right. So unemployment is a key economic variable that everyone pays attention to, at least in the US. I don't know about China since they're quite opaque, but unemployment is a very important variable to think about. Consumption. So you have a job, and instead of saving, if you consume, there's spillover effects, right? If I go out, instead of saving my money, I decide to buy this product, I decide to consume this, I'm supporting businesses in the overall economy. And so consumption definitely will boost overall output of a country, right? So consumption is also important. Trade and current account balance. So if I decide to export, right? If a country decides to export, that means that they are not consuming what they make domestically. So exporting is another way to say savings abroad, right? Instead of consuming the good produced, I'm going to export it so that maybe I can consume something in the next day. So current account, import exports is also related to borrowing, lending, and saving, as you will see. So I'm going to prove this mathematically, but that's the idea. If I'm a closed economy, trade current account balance doesn't matter. okay? But in open economies, I can export my excess, in other words, save, and extend my credits to other countries so that I can consume later on. So I can consume more potentially in the future if I open my economy to trade. So therefore, EX minus IM is an important variable to think about, right, in terms of income. Our national income. All right, and lastly, money, price level, exchange rate. I've talked about this already. Price levels is, inflation rate, right? Inflation rate matters because inflation erodes the purchasing power of your currency, which is related to money supply, the speed of change in money supply, and also your exchange rate policy is also important. So the example I gave you was Hong Kong, right? Their exchange rate policy is pegging to the US dollar. That's going to impact interest rates, inflation rates, et cetera. Okay. All right. So hopefully you're convinced we should care only about, our starting point should be income at the national level, at the country level. And CI, G, EX minus IM should all be very important to think about. So Y is going to be our measure of national income. So I want to make it clear that in some textbooks, GNP is basically GNI, gross national income. So in this class, I'm just going to say GNP, but that's what I'm referring to. Okay, I'm referring to the national income of a country. So how do you measure national income? There's these 5 variables to consider. Okay, consumption, I think is obvious, right? Money you have that you spend, that should be a component of your income. Investments. So again, this investments is private investments. So I'm not talking about government investments. I'm not talking about foreign investments. That's actually captured by this, okay? I'm not talking about foreign investments. I'm talking about private domestic investments. So if you have money, right, you have disposable income, and you instead of spending it, you decide to save, that's also part of your income, right? So savings and consumption, correct? G is investments on behalf of your government, right? Or consumption. So G is actually public C and public I, right? Government can spend your money, government can invest in your money, right? And so G is therefore a component. So where does government money come from? Exactly, taxes. So it's basically your money, right? It's tax. So taxes, private consumption, private investments, and lastly, when you open up the economy, instead of investing domestically, you can actually invest abroad, right? But investments can take 2 types, can come in 2 forms, right? Financial investments, which is captured by this, it's hidden, okay? But for now, just think of it as commodity flows. Or investments in terms of real goods and services, right? If I don't consume what I produce today, I can sell it abroad to somebody else so that I can consume later on. So what I just described to you sounds a lot like savings, right? I can save today, postpone my consumption today so that I can consume later on, right? I lend out my goods and services so that I can buy stuff with their currency that they gave us sometime in the future. All right. Comments, questions, I will, let me give you a more precise definition so that I clarify the difference between GDP, GNI, and GNP. So let me give you a table here. Medium. So income earned by GDP. Pretty large. Okay. GNI, GNP. So what's this? Foreigners in the country. Okay, cool. Foreigners in a country. GNP, so income that's earned by foreigners in a country. So if Tencent opens an office in Silicon Valley and they move some workers over there and they pay them income to live there, that will be included in GDP. Includes. GNI includes if spent locally. And GNP excludes. Residents outside. GDP, again, is defined based on the physical boundaries, national boundaries. So that means that if you have international companies having offices in Ireland, that's going to be excluded in GDP. So the money that's made by Google in Hong Kong, that's not part of GDP. For GNI, it includes if remitted back. So if workers in Hong Kong working for Google decides to deposit their money in an American bank after getting paid in Hong Kong dollars, then it's going to count towards GNI. And GNP will includes all. And lastly, foreigners. I think this is obvious. Foreigners outside country. This should be exclude. So in my notes, I will use GNP predominantly, but just note that I think of GNP and GNI basically the same. It's just that GNP was calculated more frequently in the past, but nowadays I think their data, macroeconomic data is quite good nowadays, and so GNI is just calculated outright. So if you do go looking for this data, you can. The World Bank and IMF both have data at the country level, of course, for GNI. So it's you can find it quite easy. Okay, for those of you who are interested. All right. So let me talk about an example to kind of emphasize the difference between GDP and GNP with this thought experiment. So I'm calling this the Robinson Crusoe example because we're imagining ourselves an economy based on an island. So an island is typically what we think of as a closed economy because they're not bordering any countries. But suppose that in this model, so Robinson Crusoe is a novel about a person who lives on an island. Okay, that's why it's called Robinson Crusoe. But suppose a country decides to trade with a nearby island, and we're trying to think about how GNP and GDP can differ in this thought experiment. So imagine we have the following production machinery, okay? So suppose we have palm trees, okay? Palm trees produce seeds, you can plant the seed, and this is our, this is our machine that produces things in this economy. So one palm tree produces one coconut and then it dies. Okay, so that's the production machine. So if you are the sole person living on this island, you can do two things. You can eat the coconut or you can save, right? Plant the coconut in the ground and let it grow to a tree again the next time. So consume. Or plant and save for the next year. All right, so suppose the one islander, the one person living on this island with this machine, harvests 100 coconuts and borrows 10 from a neighboring island. And gets, okay. And suppose that he plants all and gets 110. So my question is, in terms of coconuts, what is the GDP and GNP if he decides, if he has to, pay back what he owes? Okay. So I think GDP is quite obvious, right? GDP production within the boundaries of the nation. The nation is defined by the water around it. So if it produced 110, then GDP should be 110, right? But GNP, not all of the output or income generated belongs to the islander. Agree? It borrowed some coconuts in the beginning. So after servicing its debt of 10 coconuts, what is left is what is the income that's being generated by the island, right? Which is 110 minus 10, which is 100. Right. So this thought experiment should give you an idea, help you understand why certain GDP per capita countries are so large despite being so insignificant, right? Think about if you have a computer with you, go ahead and look up like Ireland or I don't know, like those tax haven countries, even Macau, okay? Think about Macau. Their GDP per capita is like 150 US dollars per person, okay? Which is insane, given that the US is like 60, 70K, right, per person. The reason is because a lot of the money that's being stored in these countries in their bank deposits don't belong to the country. It's actually being moved out later, right? And so GNP or GDP, Ireland's, you can check, Ireland's GDP is probably 20% larger than GNP or GNI, sorry. So don't look at so the takeaway here is don't look at GDP as a metric for, I guess, how well people are doing in their country, right? Because a lot of the wealth is not theirs, right? It's not the money they made locally, it's made by foreigners. What you should be looking at is GNI. Okay. All right, so let me recap a bit. So I motivated our dive into macroeconomic accounting by thinking about the country as just another household that is looking to borrow money or borrow in terms of real goods and services, right? It's credit worthiness. And the first thing to look at to determine credit worthiness is to look at how much money it's making. So we started out with GDP. We explained why GDP is bad. I gave an example with Ireland. And so hopefully you're convinced that we should think about national income. national income, its components should be the same as GDP, but just making sure that we're thinking about residences and companies that's operating and paying people and spending money within the country. C plus I plus G, consumption and your savings, right? These are the two things that represent disposable income at the household level. G is just think of it as just another household. It can also save, it can also spend. So C plus I plus G should be, should not be controversial, right? EX minus IM is somewhat, I think, hard to grasp at this moment, but the way I explained it is you can think of it as savings abroad in terms of financial investments. Yes, EX minus IM should include investment returns abroad, which I'll explain later. But it can also represent lending and borrowing in terms of goods and services. When you export something, you are denying yourself of consuming those things today, and you're lending real goods and services to other countries today. You take their money, you extend them credits so that you can spend potentially what you want sometime in the future. So EX minus IM is just savings abroad, savings or borrowing abroad in terms of financial terms, or in terms of real goods and services. So hopefully this definition should be not controversial, right? Should be, I think, obvious. All right, so how do we keep track of commodity flows? So there's two accounts that you should pay attention to when you're looking at macroeconomic accounting. One is the current account, which tracks commodity flows, imports, exports of physical assets like machines, or physical goods and services, or intangible goods and services like consulting, whatever. Those things should show up on the current account ledger or whatever, documentation. Financial accounts is import, export of financial assets. So if I buy something, even if it's physical goods and services, I still have to export money abroad, right? So that should show up on my financial account. So anytime I export or import currencies, or even bonds or stocks, it should show up in a financial account. Okay. From a purely commodity flow perspective, if you're just buying and selling financial assets, current account should not change, right? If I go and buy stocks from another country, we exchange currencies, they gave me stocks, I give them currencies. There's no physical goods and services being moved, right? CA doesn't move. But in reality, the current account is actually defined more than just exports and imports. It also should include returns on investments, which I didn't show in this formula here. So there's a reason I don't do this. The reason is because I don't want to make the math more complicated than necessary. That's the first reason. The second reason is because I want to focus on commodity flows when I mention this formula, okay? But just note in the back of your head that in actuality, yes, the import-export should include returns on investments, investments abroad, okay? All right. Clear? So current account, physical goods and services, exchanged between countries, financial account, exchanges of financial assets, money, stocks, bonds, whatever. All right. So let us talk about so let me first emphasize the commodity perspective of the current account. So the first perspective. Okay, so I'm going to give you 3 ways to see the current account in this class today. The first way is through commodity flows, which I'm going to show you now. The second way is through investments abroad. Okay, and that's probably after the break. Okay, and then the third way I'm going to show you what do you call it? Exchange rate pass-through perspective. So I want to show you that the current account is a representation of how FX rates can affect the current account. Okay. I'm showing it to you today so that when I recall it, it won't be so foreign to you. Okay. But those are the three ways to see the current account. So let me recap. The first way is through commodity flows, exchange of goods and services. The second way is through savings abroad, which I will prove to you mathematically. And the third way is through the pass-through channel. How does changes in exchange rates lead to changes in the current account? All right, so the first way, we just simply define the current account as net exports, or exports minus imports. And you can easily see this by this equation here, right? Total income is represented by Y, right? And we know Y is defined as C plus I plus G plus BX minus IM, right? And we can subtract this all savings and consumption within the country, right? C plus I plus G, right? That's all savings, right? All savings and consumption. So whatever is left is exports, right? If it's negative, then it's imports, right? So whatever I make that I don't consume, or save, so C plus I plus G, get rid of it. Whatever is left, if it's positive, it's exports. If it's negative, that means I imported something, right? Net import something. So if I have a positive current account, it means that, for example, for Hong Kong residences, that means that people living in Hong Kong are giving up domestic consumption, right? They're not consuming what they produce. They're setting it aside and shipping it out. And they are giving it to somebody else who wants it today. So what do they gain from doing this? As I try to explain to you, savings can be in terms of both financial terms or in real terms. So if I export something, I'm saving today, right? So it's like lending to someone today. So Hong Kong residences gain the promise of foreign debtors to pay back in the future, right? Or in other words, Hong Kong residents sell their stuff, they get foreign currency. Sometime in the future, they can use that foreign currency to buy stuff, right? So it's as if I'm lending them today so that I can use their currency to buy stuff sometime in the future. So they receive foreign assets, right? They do receive foreign assets. They get foreign currency for net exports. So export, lending, real goods, services, or financially. Import. So this is another punchline today. Okay. Borrowing, real goods, services, or financial. All right. Comments, questions? All right, so let's take a look at different three sets of countries to see how they evolve over time. So here I have the U.S. government, or United States as a country. I have three dates for you: 2000, 2010, and 2023. We're looking at GNI or GNP here. The y-axis is trillions of US dollars. So that number doesn't matter. You should just look at the pattern over time. We see that, you didn't see it here. So GNI is the dark blue line. It has steadily grown over time. Right, so it's quite good. And you can see, and then the rest of these bars is the components, right? So purple is consumption, pink is government, magenta, I don't know, is investments, and orange is current account. The two things you should notice, number one, this is negative.
So US, I think it's notorious. Everybody knows this. US has been a net importers probably since the, I don't know, 50s. Okay. And despite being a net importer, they've managed to grow the economy quite decent. And you can see where the growth is coming from, right? It's coming primarily consumption. Right. Right. So that's the US. Let's take a look at Hong Kong. Pretty good, right? 2000 to 2023, steady growth. Also, notice the pattern here. Consumption is consumption-based here. But in contrast to the US, this is positive net exports. Right? So current account is positive, and decent growth that's driven by consumption. All right, China. China. This is very, very fast growth. Look at this, right? But you can see stark difference, right? Not only is their net exports positive, but it's not, definitely not mainly consumption driven, right? It's coming, it seems, from investments or savings, right? So remember, this is domestic investments, right? I'm not talking about investments abroad. So based on these graphs, you should be thinking like, what sort of implications does these growth strategies, macroeconomic growth strategies, imply for the kind of exchange rate policy you should have, right? US is a very hands-off, they don't intervene in the FX markets at all, okay? So their growth has to come from organic consumption demand, right? On the other hand, China has decided to go the route of, a technocrat. They want to control everything. They have, they control the flow of capital between its, within the country. And they also manage their exchange rates. They have to follow a specific path, and they decided to push their output, their growth primarily through investments, right? Domestic investments. So different, as I mentioned, I think I'll mention it later. Yeah, here, oh no, okay. Countries have basically two objectives here. They have what's called an internal balance objective and an external balance objective. Internal balance objective, we're thinking about domestic unemployment rate, inflation rate, etc. Right? Most countries kind of ignore the external balance, means they don't really care what their foreign exchange rate is or their trade balance in general. It is what it is, and they just focus on the internal balance, or on the internal balance goal. China, on the other hand, wants to control, literally every variable that they can get their hands on. And so external balance means that not only they want to control capital flows, but also want to control what their exchange rate should be. And that's going to have implications in their macroeconomic policy, right? Their economic policy for the within their country. So we'll get to that by the end of today, hopefully. Okay. Let me just quickly go over one example of how commodity flows are documented in the current accounts, and then we'll take a 10-minute break. Okay. So let me give you an example of how international trade is documented. So in this example, I have two countries. We have the US and Japan. US is a major export of movies and film. And in this example, we have US exporting movies to Japan. So that's a physical good, or IP, it's a transfer of IP to Japan. So it's a service or commodity export. And so that definitely should have an impact on the current account. So as I mentioned earlier, anything that's leaving the country is an export. anything that's coming into the country is an import. We have physical goods or IP leaving the country. That is going to be a credit, so it's a plus. Anytime there's an export, it's a plus. Anytime an import is a minus. I mean, I forgot to write that. So import is minus, export plus. So if US decides to export $10 million worth of movies to Japan, that's a credit to the current account of 10 million. Okay. Japan will pay for it using their own currency, which will be converted once it gets deposited in a US bank. Because it's an import of a foreign currency, it's going to be minus. It's a debit. But it's not going to go into our current account because it's a financial asset. It's going to go into, sorry, current account. It's going to go into our financial account. So it's a minus 10 million. No. It's a minus. I know it sounds weird, right? We're getting something for selling something, but why is it a minus? Well, it's a minus because we are actually extending credit to Japan, right? By accepting their currency, we are essentially lending them credit, right? All right, so that's an example of movies. We can also look specifically at a purchase of a financial asset. So here we have Japanese government bonds. So suppose a US bank just buys a bunch of Japanese bonds. What's being exported? US dollars, right? So US dollars is an export. Anything leaving the country is going to be a plus, right? So here we have plus $10 million worth of Japanese bonds. But we are getting something for exporting dollars. We're getting Japanese bonds, right? So as an import, is an asset import. So bonds is a literal debt contract, right? So it is, you're extending credit, right? So it's going to be a minus on a financial account. So just based on these two transactions, these instantaneous transactions, the delta, the change in the current account here is positive, right? Because we've exported movies, right? So there's a positive increase here. But in this situation here, at the very moment, there is a transaction between dollars and Japanese bonds. There is no change in CA, right? There should be none. Should be zero. But if the Japanese bonds start paying dividends, that will eventually lead to an increase in the current account, as I'll show you later, okay? But just these instantaneous transactions, there should be no change in the current account. Okay, let's take a 10-minute break, and we will finish up after the break. Oh yeah, I'm gonna circulate this, so please just pass it all the way to the end, and then if you can, just bring it back up here. Otherwise, I'll look for it here. This is the attendance. Just sign your. Yep.
Um, you can, um, you can. But I suggest you don't think of it that way. So credit just means that plus, and debit just means minus. Nothing has to be balanced. So there is no balance here. It's just a way to document transactions. Yeah. Reading is not necessarily, you can think, maybe it helps you, but in reality, it has nothing to do with each other. So it might confuse you more if you try. So my suggestion is just to remember, anything exported is plus, anything imported is minus. And whenever you're exporting, you're essentially lending. So that may be counterintuitive, right? You export something, but just remember, when you export something, you're not consuming it today. So it's as if you're saving it for later. But, right? Another way to think about it is, well, if you sell something, you're actually receiving something for it, right? Foreign currency. So you're basically lending. So that in effect, you're getting a debt contract from the buyer, so that you can redeem their money for future goods and services exported from them, right?
你卖了哦，你把资产卖给出口给国外，未来会收入
这里收入就是就是
金融，然后你就是要，就是这个房子，
yes. So just think, if you think money as just debt, then it should be super straightforward. If money is just debt, then I'm giving, so when you sell something, you're just, you give them a loan in terms of something to eat. Right? Some machine, or something to eat, some machine, but in exchange for that, you get an IOU, right? That's what money is, an IOU.
把它跟我们昨天学的会计听起来可能会比较
Yeah, I think so I think if you try to do it that way, you'll be more confused. So, yeah.
All right, sorry, attendance list is took longer than I thought, so maybe I'll just leave it up here next time and everyone just sign in whenever you want, okay? Okay, let me give you one more example of international transactions and how that impacts the current and financial accounts. So, another example of just financial transactions. So let's think about investments from Japan and private equity. So in this example, I have Japan. Let's say SoftBank wants to invest in a startup, a biotech startup. What they can do is they can invest in this company by buying their private shares, right? So here I have Japan buying share purchases. So the US is therefore exporting private shares. So remember, any export is a positive, is an addition to the financial account, a credit. In exchange for these assets, Japan will import, or we will import Japanese yen. So again, that's a form of extension of credit. That's an import, and then therefore it's going to show up as a debit on the financial account. So here, assuming these private shares are not liquidated as a return anytime soon in this period of time, the current account, the change in the current account is going to be zero, right? The delta CA is going to be zero unless it starts paying dividends or it's liquidated if you have to calculate investment returns. All right, and last example, look at an import of lab equipment. So suppose that startup wants to import some machinery from Japan. That's going to be obviously a import, so a debit on the current account, so minus. But when this startup buys those machines, it has to pay in terms of Japanese yen. So there's going to be an export in dollars. And therefore that export is going to show up as a credit on the financial account. Right? So let me reiterate. It may be counterintuitive, right? Money. We think of money as like something that's good. It's not a liability. But in fact, yes, it is a liability. As I explained to you at the beginning of today's class, it's an extension of credit, either in terms of financial sense, like you get your principal back plus interest, or in terms of real goods and services, right? So in this case, if you have an export of dollars, it means Japan says, okay, I'm happy to take your dollars as long as I get to spend them sometime in the future. So Japan therefore has the right or the ability to buy or make investments using the dollar sometime in the future. That's what money really is. It's a extension of credit. Okay, so in this case, because it's a debit transaction, delta CA is going to be negative, right? So in total, so let's say over a year, for example, over a fixed period of time, if you have a current account that's positive, we say that that country is a net exporter within that year or a net foreign lender. It's the same thing, as I will show you, whether we're talking about commodities, goods and services, or investments returns. Conversely, if the current account is negative, that country is a net importer or a net foreign borrower. Borrower, again, borrower meaning I'm consuming today so that I have to pay back later in terms of goods and services, or I'm borrowing I'm issuing debt, right? And expecting to pay interest or principal sometime in the future. All right, so my second objective with my second perspective of the current account that I want to show you today is that current account is also reveals to you the amount of investments that goes abroad. So remember, I is a representation of private investment domestically. So if we have a closed economy, all savings has to be made within the country, right? So imagine that Robinson Crusoe model, just one island. If I save, all my investments is my savings. But if I open the economy to trade, then there must be some variable that captures that investments that leaves the country, right? Non-domestic or foreign investments abroad. So I want to show you that this, I want to prove to you that this is true. Okay? That's my objective. So let me show you that now. Let me prove it to you. So I want to show that S equals I plus CA. So S stands for total savings, savings domestically and savings abroad. Let S superscript P represent private savings. We can easily derive private savings using those macro variable definitions, right? So Y stands for total income. We subtract taxes, right? That's net of now tax liability. And then whatever we don't consume, right? So minus consumption. So whatever is left over, the residual must be savings. Agree? So total income minus tax liability minus consumption, whatever I spent equals savings for that window of time. So the other kind of savings in the economy is savings from the government. So whatever the government doesn't spend from the taxes collected is therefore government service. Agree? Therefore, total savings must be equal to SP plus SG, right? Well, S without any superscript is total savings of economy. So let's just write out T minus G, C, and then minus T minus G, right? All right, let's just keep it that way. All right. So the T's cancel out, right? And we can expand the Y. Let me write out the Y. C plus I plus G plus EX minus IM minus C minus G. And that's going to be equal to the C's cancel out and the G's cancel out, right? Bum. So whatever is left is I plus EX minus IM to I plus Z. Done. Right, I proved that S equals I plus. Yeah. So whatever savings that is not going into investments, local investments, domestic investments, must be invested abroad. And that's being captured by the current account. So this is the same side. This is a different side of the same coin. EX minus IM, net exports minus imports gives you the commodity flow perspective, right? The real tangible goods and services being lent and borrowed between countries. But if we derive savings in this fashion, we can see that CA also means that it is, so let's rewrite this. CA equals S minus, right? Total savings minus domestic investments. So if S is very big compared to I, it means a lot of the money is abroad, right? All right, so let me ask you this question. So many years ago when China joined the WTO, there was, this is back in 2008. I think you guys are close, just born. A lot of newspapers made the mistake of saying that, or made the economic mistake of saying that China wants to be a net, wants to have a lot of, be a net foreign investment receiver, as well as a net exporter. So my question to you is, does that make any sense? Can you be a net FDI receiver and also be a net exporter? Is there anything that's contradicting each other? So if you receive a lot of foreign direct investments, that means that you are receiving loans from abroad, right? Which also means that maybe CA is negative, right? But at the same time, if you're a net exporter, CA could be very, very positive. So it's very hard to be those two things at the same time, right? Because you can't be a net borrower and also a net exporter, which means a net lender at the same time. So something has to crowd out the other, right? So just pay attention when you read the news, right? Sometimes they'll say like, oh, FDI investments, lots of China. China's like has a surplus current account. Well, you can't be, it's hard to be both of those two things at the same time. Okay. All right, so I did prove to you in the following slide, so I just walked you through it. So hopefully you are convinced that current account is net savings abroad as well as net export import. And this interpretation applies to both savings and commodity flows. All right, last perspective on the current account is just explaining to you that the current account is not only impacted by investment flows and commodity flows, it's also impacted by prices. That's an important channel that we must talk about eventually. The way to see how prices impact the current account, we need to borrow I need to talk about something that we'll talk about much later on. So we need to talk about what's called the real exchange rate. It's a very, very simple definition. And I'm going to use this definition to redefine the current account equation. Okay. So the real exchange rate is designated using the Q variable, but it represents the ratio between price levels multiplied by the exchange rate. So E times P, the foreign price level. So I'm going to use P star to indicate the foreign country's price levels, divided by P, domestic price level. So let me write P star represent domestic and foreign price, average price respectively. So in this class, I will always use the asterisk to indicate foreign countries. If there's no asterisk, I'm referring to the domestic country. So why am I using this? Well, I'm using this price ratio to convert domestic imports in terms of foreign exports. So imports, exports, again, two sides of the same coin, so to speak, right? If it's my import, it's somebody else's exports, but it's just at different prices. So I need a way to convert prices from domestic to foreign. That's where Q comes in, right? Q is a conversion of prices. It's a conversion of prices, right? Of goods and services, average goods and services between countries. So what I'm doing is looking at domestic imports, which is priced in local currency, and then decomposing it into foreign exports. So that's EX star multiplied by the conversion rate, which is the price levels between those two baskets, right? Foreign and domestic multiplied by E, the exchange rate. Make sense? So let me say that again. The current account definition that was presented to you earlier is equal to exports minus imports. Anytime there's no asterisk, it means these numbers are in quantities of local currency, US dollars, Hong Kong dollars, Chinese yuan, whatever. But I want to interpret IM instead of domestic currency, but in foreign currency. That would mean I need to interpret imports as another country's or an average country value exports, right? So IM therefore can be thought of as EX star, right? Just some other countries or an average country's exports. But I have to convert these currency values into domestic values. Two steps I need to do. One is to convert the prices, right? Our P star for their P star, my P for their P star, and then converting their P star back to our domestic currency with the exchange rate E. So E is price of foreign currency in terms of domestic. So that means that if I multiply E by P star, I get domestic currency back. Agree? So I think going from here to here should be not too difficult to accept if you think about it from a two-country perspective. So let's say country A, country B. My imports is just your exports. So let me write my imports in terms of your exports, but I have to convert your exports to my price levels. So I need to have an exchange rate, a real exchange rate, because it's a price ratio, multiplied by E, so that I'm converting your price levels to my price levels. Okay, so EX minus the real exchange rate multiplied by EX star is just my imports in terms of my currency. All right, so based on this equation, you can see, therefore, how prices can affect the current account. Right, so you see this pass through. The price level pass through to so what this tells us is that as foreign goods and services become more expensive, in other words, as P star increases relative to our prices, so let's say P, that means that their goods and services are becoming more valuable than ours, right? If their price levels are increasing, P star divided by P. Remember, we're talking about for the comparable consumption baskets between countries. P star divided by P, if their P is increasing, that means that the current account is going to decrease. Right. And the reason why it's decreasing, it's more boring than it is. I mean, it's more boring than insightful. Okay. It's basically saying that if trade flows don't move, and all that's happening is that their goods and services are being more expensive, that's going to erode the current account levels. Yeah, that's basically what it's saying. Assuming no trade volume changes, if their goods and services are becoming more valuable, that's going to undermine our current account levels. Because their goods and services are being more expensive, but I'm still buying, you see? So no change in commodity, no change in trade volume. I'm not buying, I'm still buying what I said I was gonna buy, but it's becoming more expensive. And if I'm still buying at a more expensive price, then the current account is gonna decrease. So that's the mechanism here between prices and net exports or current account. All right, so why am I talking about this? I'm going to talk about this is because, as I mentioned earlier, from a policymaker's perspective, you want to know how, if I decide to intervene with price levels through tariffs, et cetera, how does that impact trade flows? How does that affect net exports? And this obviously matters if you're a country that cares about the current account balance, like China. Okay. Alrighty, so for the last hour or so of this class, I am going to give you essentially a quick history lesson, okay? I'm not going to talk too much in details. What I'm going to do is just talk about different exchange rate regimes that has been in place from the around the 1800s, 1700s up to modern day, okay? So international monetary systems, past and present. And I began by my discussion on why there's so many regime changes. The reason is because there's often conflicts between these two objectives. One called the internal balance, where you have to worry about the economic well-being of your domestic country, and your external balance, meaning if you choose to, have an optimal current account level, right? Most people would think, in order to be sustainable, right? In order for a country to be sustainable, you should have a current account that's close to zero. I don't know, do you believe that? Or positive, right? Positive or equal to. If you talk about mathematical models, probably yes, right? You probably want either a zero current account level in the long run or slightly positive. But that's not everyone believes that. So there's different, modeling choices you can implement that in which maybe a negative current account can be sustainable. And US is one of those exceptions, right? It has had a negative current account since everyone got off the gold standard / dollar standard. Okay. But my point here is that sometimes concerning yourself about the current account being positive or equal to zero may conflict with your objectives of having full employment and price stability. Okay, and this conflict has arisen several times over the last 100 years because people go to war, obviously, right? When you go to war, you want to boost your economy or maintain your economy, but at the same time, you want to sell things to get money to finance your war. And to finance your war, you need to make your exports cheap. And one way to do that is to make your domestic currency weak, right? And so when you make your currency weak, somebody has to have a negative current account, right? Somebody else. So this is what's called the beggar thy neighbor problem, is when everybody wants the same thing. There has to be at least one person who absorbs all the imports. Who's that going to be, right? That's a big problem. All right, so that's the premise here. So we have we have basically two types of exchange rate regimes over the past few centuries or so. And we've been on and off gold standard and dollar standard because people have incentive to break their promises because they have overly concerns about their internal balance at the expense of external balance. Okay. All right. Let's see. All right. So from the beginning, from the 1700s or so, the gold standard is what countries abided by before World War I. Okay, so what that means is that every country fixes some. So let me describe to you the arrangement here. The gold standard means that you need multiple players, multiple countries agreeing to fix their conversion rate from local currency to your domestic currency. So just like the US dollar you saw, the dollar is redeemable for some quantity of gold. There is a conversion rate set by the bank. And under the so-called gold standard, where you have a consortium of countries agreeing to fix their currency to some quantity of gold, exchange rates become extremely boring because it becomes deterministic, right? So just think about it. Every country fixes 1-to-1 to gold, like $1 per ounce. Some countries fix 1 Chinese yuan to 2 ounces of gold, whatever. They choose their conversion rate. Given that each country chooses the conversion rate, the exchange rate between dollars and Chinese yuan and British pound sterling should all be deterministic. You agree? If every country fixes their exchange rate with gold for some quantity conversion rate, indefinite quantities, unlimited quantities, then exchange rates become deterministic. So I'll give you an example. in a bit. All right. So that's the setup. So that was what the exchange, what the FX regime was like in the very beginning. And now I'm going to try to explain to you the mechanisms in which this standard maintains itself. Okay. How is this standard self-sustaining? That's the question you should be asking yourself. Is it self-sustaining? So let me explain to you, first of all, the mechanisms. How does the gold standard work when a country decides to buy goods and services from a country that has this gold standard in place? So suppose, hypothetically, Hong Kong is on the gold standard. And some country sends, or some companies from some country decides to buy apples from Hong Kong. So how does the gold standard play in this situation? So let me give you some numbers to work with. So suppose we have 10, for apples, okay? So suppose the price of apples in Hong Kong dollars is 10. Let me use 10 per one apple. Okay. That's the price of an apple, $10. Okay. Under the gold standard, if there is a standard and everybody agreed for some conversion rate, suppose Hong Kong says, if you have Hong Kong dollars, you can redeem 1 ounce of gold if you have 10. So the price of 1 ounce of gold is 10 Hong Kong dollars. So the price of apples in terms of gold is what? Just 1 ounce, right? So I know everybody's metric. I know everybody likes metric and everybody outside of US, but ounce is a unit of weight, okay? And it doesn't matter how much it is. I don't know what it is. I don't know what the conversion rate between ounce and grams, but anyways. All right. So that's under the gold standard. This number cannot be changed. Right? I said in the beginning, if we have a gold standard in place, every country announces to the world that they will be able to convert some quantity of currency for some amount of gold, unlimited conversions. Doesn't matter how much gold you have, how much gold you have or how much fiat currency you have, the central bank will convert it to and from infinite quantities. This cannot be changed. Now, if a trader, let's say a fruit vendor from a different country, decides to buy apples from Hong Kong, what they will need to do to buy apples is to somehow find a way to get Hong Kong dollars, right? That's the only way to buy apples in Hong Kong. You have to have Hong Kong dollars. So what will they bring over? They're going to bring over gold, right? So if they bring over gold to Hong Kong, then the price of apples in terms of gold should increase or decrease. So Hong Kong has more gold now. And so based on supply and demand, right? How should the price of apples in terms of gold in Hong Kong increase or decrease? There's more supply, okay? So the answer is the price of apples should increase, right? More demand drives up prices, or in other words, you can say it in this way, more supply of gold means gold is now relatively worth less than before because there's more gold in the system. So with more gold in the economy, the price of apples will increase, which means what? I just created inflation, right? It's not just apples. If they buy other stuff that's priced in terms of gold, it's also going to increase. So I've created inflation. So inflation in terms of gold, but if you look at the gold standard here, this can't be changed. I can't change this. I cannot change this under gold standard. Which means that if I get inflation in terms of gold, I must have inflation in terms of my nominal currency. Right? My fiat currency also has, the nominal price of apples must also increase. So in other words, under the gold standard, if there is an import of gold or an export of apples, right, there must be inflation. So prices, right, P has to go up. You agree? So this is the mechanism, okay? So I'll prove to you through this logic that yes, in fact, they're what's called the price specie flow mechanism. The gold standard is sustainable, meaning that there will be a stable equilibrium. There must be a reversion somehow, right? Now I'll show that to you later. But that's the idea here. Hopefully you see it, right? So the takeaway here, import gold inflation, export gold deflation. All right, so let me make it clear. What does central bank's duties under the gold standard? Under the gold standard, there's no such thing as monetary policy. The only policy that they have is that they maintain the conversion rate between gold and fiat currency, whatever it is. It is up to you to this, up to the country to decide what that conversion rate should be. They determine that conversion rate, which means that that rate basically gives them their ideal current account level, whatever it is. But for now, for simplicity, we can just say everybody wants to have current account equals 0 in the long run. Okay. If that's the case, I will show you based on this logic here that the example I gave you here, there is a counter effect that cancels out this inflationary effect. Central bank, again, no monetary policy. Their only task is to maintain the peg or the conversion rate between their currency and gold. There's no lender of last resort, no bailouts, because any sort of bailout will change the conversion rate between dollars and gold. Okay, they can't change money supply. The byproduct, as I mentioned already, if everybody has a fixed exchange rate with gold, then by definition, exchange rates are deterministic. They are fixed. Now, let me talk about why it is self-sustaining. So in the case in which there is inflation. So in our example with apples, right here, if we have a export of an increase in apple sales abroad, then the current account is going to be, the change in the current account is going to be positive, right? So continuing off that example, suppose the country has now a surplus as opposed to a current account balance. So let's CA is positive. And we learned that when the export is positive, there's going to be an import of gold, which creates inflation. That means domestic price levels, assuming it's beyond just apples, okay? So bring in gold, they're going to buy other stuff too, right? So overall price levels are going to increase. So price of all other commodities in the whole country is going to increase relative to gold. Now, the counteracting effect comes from the fact that people will substitute for cheaper goods for the same good, they will try to find the best price. Right? If Hong Kong sells iPhones for, I don't know, 2,000 US dollars, but they sell in Macau for $1,500, you definitely would go to buy Apple iPhones from Macau as opposed to Hong Kong. So in this case, with higher price levels, we should see people in Hong Kong substitute away from their own domestically produced goods for foreign goods, right? Assuming goods and services are comparable, substitutable. So the higher domestic price level will make domestic goods more costly for both domestic and foreign residents, right? Because P is higher than before. And so what they will try to do is you see people eschew, right? They won't buy from goods and services from Hong Kong anymore. They're going to try to buy goods and services elsewhere. And that's going to increase imports, right? Which means that current account is going to restore back to 0, right? And this is all done through changes in price. So let me say that again. In our Apple example, we can generalize this to just overall imports, exports in general. If a country wants to buy a bunch of stuff from Hong Kong, they have to bring gold over and convert the gold to local currency. If they do that, inflation must occur, as we know, because you cannot change the exchange rate, the conversion rate between local currency and gold. The only thing that must happen if there's more gold is the fiat currency price of goods and services must also increase as well. So we have an initial current account surplus, right, because of exports, but as prices go up, people would want to now try to find cheaper alternatives than Hong Kong produced goods, right? It's too expensive. People want to try to buy cheaper alternatives. So what they'll do is they will try to import other goods from elsewhere. How do you import stuff? You got to export gold, right? And that's going to lead to a current account balance again, right? So this is what's called the price specie flow mechanism. It's through prices that the current account balance reverts, right? Because people want to substitute away from expensive goods towards cheaper goods if they can substitute away. And this is self-sustaining, right? The only assumption we made is that central banks maintain conversion rate between their currency and gold. But by saying that, it's kind of clear why this system broke down, right? What happens if a country runs out of gold? We'll have a country that doesn't have any gold, right? You have major problems under those circumstances. All right, so let me demonstrate to you how this is self-sustaining from a financial perspective. So whatever I just gave you, the price specie flow mechanism, that's more of an economic / price explanation, right? People substitute away from expensive goods for cheaper goods, and imports cancels out the export. There is a financial perspective as well of why this is sustaining. So let me give it to you now. Let me give you the example. So suppose you have two countries with pegged exchange rates conversion rates between gold. So let's look at United States and the United Kingdom. So the domestic currency is going to be US dollars. And the foreign country is going to be UK. The conversion rate, let me show you that. The price of 1 ounce of gold in terms of British pounds is 1 to 1, okay? And the price of 1 ounce of gold in terms of US dollars is 2. So based on that, I'll just write it down here. The implied FX rate is USD per GBP equals to 2. Agree? So every country pegs their currency, right? Then if I want to convert dollars to pounds directly, the price is just $2 per pound. All right, so is this system sustainable? Right, that's the question I ask you. So that means that if the price deviates away from 2, is there arbitrage profits? Right, that's the question you should be asking yourself as financial practitioners. Is there a way to make something from nothing if the price deviates from this implied price? Of course, because 2 prices for the same thing definitely cannot exist. So let's suppose, for the sake of this example, the observed exchange rate between dollars and pounds is 3. Okay, and suppose what you observe in the market, in the FX market, is 3. How do you make something from nothing? Well, let's borrow 2 USD. And then redeem 1 pound at the price of 2, right? At the implied price. Gold standard, right? You sell 1 pound for 3 USD, right? At the whatever's quoted in the markets. And then you will return 2 USD and have 1 USD. Here's this. All right, so how do okay, so this step here, obviously several steps has to be taken. I have to borrow $2, go to the bank, redeem for gold, bring the gold over, right? Convert the gold back to British pounds. That's how I get 2. I mean, that's how I get 1, right? From the implied exchange rate. I have to go through these several steps. But you can imagine, like, just making a phone call between these 2 countries and say, this is what I want to do. I want to borrow 2 USD and then redeem 1 British pounds and put it in my account. Fairly easy, right? So step 1 requires you to call up these 2 central banks, convert currencies to gold, convert gold back to another currency. And then you exploit the price difference, right? You borrow low and you sell high. And you return what you borrowed and you have 1 USD free, right? So what's going on here is that this act here of selling British pounds will push E towards 2, right? So E says the price of pounds in terms of dollars is 3, right? If I keep selling pounds, then the pound value relative to the dollar is going to decrease, right? The pounds is going to depreciate over time. And it's going to depreciate over time until this strategy is no longer profitable, right? All right, so that's the financial perspective, right? It's self-sustaining, it's sustainable financially, right? In the FX market, if there's a deviation away from the implied exchange rates, you're going to get arbitrage profits. So if it does exist, it won't exist for very long. In terms of economics, what's the mechanism at play? Well, it's through price levels, right? If you have imports of gold, you're going to change price levels, and people will have incentive to substitute away or substitute for cheaper goods, right? And that's going to reverse the current account imbalance, so to speak. Good. Comments, questions? So this may be confusing, so maybe I'll reiterate again what's going on here, okay? So the question is, is the gold standard sustainable and maintainable? And the answer is yes, if and only if central banks are willing to maintain convertibility of domestic currency for gold in unlimited quantities, right? Every country can do this. Suppose every country can do this. You can prove it sustainable in terms of economically, right? So when I say sustainable, I'm meaning that every country gets to clear their current account balance, CA equals 0 or whatever, okay? Let's just say it's 0. So if we have a deviation away from the current account, so this is the exercise here. If we have a deviation away from the current account in a positive direction, so let's say there's a surplus of exports, that means that other countries are bringing gold into your country, there's import of gold, and that's going to cause inflation. We learned that we should be convinced that this is true with the Apple example, right? You bring gold in, more gold chasing the same amount of goods and services, domestic prices must rise if I cannot change the convertibility of gold and domestic currency. Prices rise as a result of the current account imbalance, but as prices rise, countries want to substitute away from expensive goods for cheaper foreign goods. And once they do that, imports starts rising and the current account balance restores back to itself previously, assuming that goods and services are substitutable. Okay, that's the economic explanation. Okay. Financial explanation in the FX markets is sustainable because if there's a deviation away from the implied exchange rate, then you can have arbitrage profits. And what that means is that those profits should not exist for long. There are price pressures that pushes the deviation away, towards the implied exchange rate. So you can see the exchange rate, right? The implied exchange rate, it is fixed, right? It is fixed. So deviations away from the fixed exchange rates will mean arbitrage profits. Okay. So as you can imagine, the gold standard and the arguments for price specie flow mechanism, it feels like that equilibrium restoring mechanism can take a long, long time. And yes, that's true, because moving gold from one country to the other can take a long time, and prices change very slowly as well. Okay. And many economists, such as John Maynard Keynes, famous economist, thinks that more can be done to improve predictability of price levels. And what he suggests is that rather than actually moving gold around, why don't countries just simulate inflation and deflation through changing money supply, right? So we saw earlier with the example of apples, right? Price levels change in response to import-export of gold. Keynes says, let's just forget about moving gold around. Let's just say if a country says they're going to buy something from our country, we'll just simulate the inflation by creating inflation through changing money supply. So that's what's called rules of the game in various textbooks and academic papers. Okay, so we just simulate the price specie flow mechanism by creating inflation when there's going to be movements of gold, or creating deflation when there's exports of gold. So in other words, we can just keep gold in our vaults, right? And we just play this game on paper, essentially. Yeah. But as you may have guessed, this is not sustainable for obvious reasons. 1914, that's when World War I broke out. People started depegging from gold, and there's no reason for them to play by the so-called rules of the game. So rather than create inflation, they might create the opposite effect so that gold stays within the country, right? So if, let's say you're at war and you know that gold is the universal currency to buy stuff from every other country, and you want to finance your war efforts by buying, materials everywhere. How do you keep gold within your country? You have to cancel out the inflationary effects somehow. So rather than create inflation when gold comes in, you create the opposite effect. So the rules of the game says you should simulate, but to break it, you just do the opposite, and gold will stay within your country. Okay. So starting from 1914, World War I, people just have incentives to not play the game anymore. And they try to make their currency as weak as possible, and they try to hoard gold as much as possible. And that's where everything went really bad. Okay. So let's use United States as the case example. So this is gold convertibility from 1800 to 1971. So starting in the 1800s, before the Civil War, we have conversion of gold in terms of dollars per ounce of around 20, right? So far, so good. But this is the depegging that occurred, right? They suspended convertibility of gold to make their currency as weak as possible so that their exports become very, very attractive, right? And this is when US Civil War took place. Okay, 1860, around 1860. All right, after the war, back to the gold for a little bit. And then you had World War I, World War II, a lot of fun stuff, okay? So, okay. So I gave you some historical break points of when countries start returning the gold standard but fail. So I think by the late 20s and 30s, basically nobody really followed the gold standard anymore. And you can already see why it's problematic, right? There's really no incentive to stick to the gold standard if you when you have internal balance problems, right? You have war, or you have massive unemployment, and you want to boost your economy through exports. You're going to find ways to devalue your currency, right? To get off the peg, to make your exports more attractive. All right. Before I go on to the next era, is there any questions about the gold standard? So the takeaway here is that I defined the game, right? The gold standard is you have to have a group of countries willing to peg their currency to gold by some amount of gold for some amount of local currency. When that's the case, exchange rates are deterministic. There's really no so-called market, because if there is any sort of deviation away from the implied exchange rates, there's going to be arbitrage profits, right? That can't be sustainable. It's the economic explanation for its sustainability is through the price specie flow mechanism. Changes in price levels as a result of import and export of gold is what drives substitution effects and changes the current account commodity flows. It's unsustainable because nobody really wants to sustain infinite convertibility of gold for very long, especially when you have internal turmoils or international wars with other countries. Okay, and so after the World War II, the countries adopted what's called the Bretton Woods system. So the only country that really escaped unscathed from having war on their soil is the United States. So in order to facilitate recovery of all those other countries, the UK, all those European countries, Canada, all those other countries that were involved in World War II, they would peg their currency to dollars, okay? And the US would peg their currency to some quantity of gold. So it's a two-layered system under the Bretton Woods system. You have all other countries pegging their currency to US dollars, and the US dollar would be the sole currency that would be pegged to the gold. So that was the arrangement under post-World War II. Okay. So why did they do this? They did this because again, US was the only country that really didn't suffer too much economic damage from World War II. And it facilitated lending and borrowing through the IMF, which is run by the US. And so let me talk about the pros and cons of this arrangement. So the pro is that post World War II, every country other than the US wanted to recover from the war through exports. So what that means is that every country wanted to somehow devalue their currency relative to the dollars so that they can boost exports. But you can already imagine how this can become problematic for the US in the long run. If every country that's trying to recover wants to do this through exports, then there must be one country that absorbs the net imports, correct? So America became what's called the nth country, the country that absorbs all the other net exports from everywhere else. And so US just began having a current account deficit ever since. This is problematic because, as you can imagine, a negative current account means that the US is borrowing constantly, right? Negative current account means borrowing, not only in terms of goods and services, but also financially. And if that's the case, you would have to believe that US growth is, on a positive path that can maintain this negative current account for however long you think it should, right? This is what's become what's called the confidence problem. So imagine if everyone suddenly believed that the US is no longer credit worthy, what's going to happen? They're going to try to redeem their dollars for gold, right? It's like a bank run. So that's the confidence problem, just like a bank run. If the US economy collapses, everyone collapses. Everyone will try to convert their money to dollars and dollars to gold until, who knows, okay? All right, just to summarize again, the arrangement is the following. We have all the countries benchmarking their currency to the US dollar under the Bretton Woods system, and the dollar is the only currency pegged to gold. They did this because it's easier to lend to other countries during post-war era. And also, it allowed other countries to satisfy their so-called external balance, right? They wanted net exports. They want to boost their economy through exports. They want to make their currency as cheap as possible. And this is achievable, making the US the nth country. But we get what's called the nth country problem because US turned out to be the only country to absorb the residual exports of all other countries. And that's only sustainable if you believe the US economy keeps growing on a pace to, sustain continuous borrowing and in terms of real goods and services or financially, right? Okay. You get this, what's called Triffin dilemma, because if the US has any indication of failure or collapse, you will have what's called a bank run problem. People try to redeem their dollars for gold, right? And that's bad. Bank runs are bad, okay? All right, so after the abandonment of the Bretton Woods system, all currencies now are free floating for the most part, okay? Meaning that it's backed by your belief and faith in the government. That is what's maintaining the value of a currency. So as a result of this abandonment, gold price has been a metric of basically how confident you are with fiat currency. So during various crises, there has been flight to safety, right? Gold is the safest asset you can imagine if you lose confidence in your country. And so here I have gold price in terms of US dollars from post-Bretton Woods, 1971, to the financial crisis of 2008. So as a result of floating currencies, you have frequent crises, right? Because people tend to lose confidence in their countries every 10 years or so. And so here we have banking and loans crisis. There was a bank crisis here, so people move away from dollars to gold. And here we know what happened. There was a liquidity shock. The banking sector over leveraged in, toxic assets, MBS, mortgage-backed securities. People abandoned the treasuries and dollars and moved towards other safer assets like gold. So gold prices spiked. All right. Comments, questions on the history of international monetary system. So let me briefly recap for the last 2 minutes we have in class. So I have a set of summary slides that I've also uploaded that you can look at after class. I think this is helpful for students pinpoint what the important takeaways during lecture. All right. So today we talked about macroeconomic accounting. The reason why we talked about macroeconomic accounting is because we want to think about the credit worthiness of a country, and therefore as a starting point to determine how to price FX, how to determine the strength or weakness of a country's currency. Current account can be defined in two ways, and I gave you three, but two important ways. One is net exports in terms of commodity flows, and the other is through savings abroad, right? Total savings minus investments, domestic investments. A positive current account tells me that you're a net exporter of goods and services or a net lender, right? Savings abroad. Yeah, a negative current account is the opposite. It means that you're a net importer or a net borrower in terms of goods and services or in terms of debt, right? All right, and the third explanation of the current account is I define the current account in terms of price levels, right? To give you an idea of how prices are related to commodity flows, right? Import, exports of the country. Okay, so I posed some questions for you here. Why is excessive current account a positive current account bad? So this is something you should be thinking. Why is excessive current account, positive current account bad? Well, if you have a very, very positive current account from a financial perspective, it means that your total savings abroad is very, very big, right? S minus I, small I, big S. And which means that you may not be investing in your own local economy very much. And that would mean that much of the spillovers in terms of technology development or housing development, that's not being realized. And it's possible that the returns that you get investments abroad may not actually be very good or safe, right? Could be risky. And so in other words, excessive foreign lending is not necessarily a good thing. So think about Chinese investments in Africa, right? A lot of those projects are dead ends or just for political reasons, right? It's not a really good investments. I would say investments on your money. It's mainly for political capital. All right, and excessive negative current account, I think that's obvious, right? If you have a very, very negative current account, it means that you're borrowing a lot today with the expectation that you can pay back sometime in the future. That's also very risky because not everyone believes that your country will grow enough so that you can allow your lenders to buy stuff from you in the future, right? Your investments their investments in you may not pay off, especially if you have excess investments. Debt. An example was during 2011, there was a credit downgrade for US. So if US experiences so let's not talk about US, maybe one of those South American countries in which their credit becomes really, really bad and there's no way they can service their debt, then you lose money, right? Investors in your country's debt will basically you won't be able to recover your initial investments. All right, the last thing I talked about was the gold standard. So the gold standard is a extreme case in which every country fixes a quantity of their currency for some quantity of gold, and therefore exchange rates are deterministic. So any sort of reason to model exchange rates in terms of asset pricing framework is nonsense because it's known well ahead what it should be. The gold standard is sustainable only if and only if countries are willing to maintain convertibility of gold to their fiat currency. If they deviate or they decide not to do it, then yeah, it doesn't work anymore. Okay. But the key mechanism at play under the gold standard is that if you have imports of gold, it's going to cause inflation, and exports of gold is going to cause deflation. Right. Given inflation, deflation, that's going to, again, under the price specie flow mechanism, that's going to incentivize countries to substitute away from more expensive goods towards cheaper goods. Right. That's the mechanism at play. Right. So I kind of explained this already. All right. And then lastly, I talked a little bit about the rules of the game, which I don't think is very interesting. It just means that rather than rely on prices slowly changing as a result of movements of gold, we just simulate inflation deflation through monetary expansion. So I gave you examples here. So you can do this through buying domestic assets, for example. That's one way to expand free money supply. For deflation, you can sell domestic assets. So I'll talk more about this later, but that's the idea. You can conduct monetary policy, buying or selling foreign or domestic assets to change money supply, which creates inflation or deflation. And that's what Keynes proposed. So rather than moving gold, we can increase predictability and control for the central banks if they just follow these so-called rules. But as you imagine, conflicts with external and internal balances leads to the breakdown of the system. Okay, that's it for today. So if you have questions about what I spoke about today, you can ask me now. Otherwise, I'll see you next week.